We begin this hour with stocks lower as traders weigh fresh tariff uncertainty. Mike Wilson of Morgan Stanley says the focus is shifting to growth, writing potential growth headwinds from DOGE, tariffs and immigration have come together to reinforce the view that the first half of 25 will be choppier for stocks than what we experienced through much of the fall of 2024. Mike joins us now for more. Mike, good morning.
Good morning, John.
Are you seeing those growth scares reflected in market internals in a more pronounced way in the past few days?
Well, not just the past few days. It really started in December when rates kind of got through 4.5%. That was the first shot across the bow. And then obviously the policy announcements that we expected, the initial announcements are all kind of growth negative and probably not conducive for inflation either, which keeps the Fed on hold. So the combination of all of that. I would also throw one more into the hopper, which is sort of AI CapEx, which is now being called into question that, there's a deceleration going on. DeepSeek didn't really, help that, sort of view. And that's where the leadership has been. So, a lot of the reasons why, Germany and Europe is rallying and even China was because the Mag 7 has really underperformed. So there's a lot going on here. I want to go back to what we were talking about earlier in terms of the consumer confidence number. Lisa, you mentioned that it's a conference board coming out. That one is very centered on the labor markets, whereas the University of Michigan is more about financial, positioning, like how do consumers feel about their financial standing. So this is an important one because if that's really, really weak, the Fed may pay attention to that. They know that. And so it could be a positive in some ways because everybody now assumes the Fed is on hold, at least probably through June. That's our view too. But if you start to see more signs that the labor market is weakening, that will give the Fed room to maybe bring that cut forward. So there's a lot happening. I think this is what we expected this year in the first half of the year. The last thing I'll bring up is the economic surprise index has a 60-day lag with 10-year yields. So part of the reason why we saw an increase in economic surprise is because rates went down so much in the fall. Now they've gone up. And the good news is that if that stabilizes here at 435 or so, you may see then a pickup. So it's just this ping pong back and forth. And it's a trader's haven, but it's not great for deploying a lot of capital.
So let's unpack some of it and let's start with tariffs. The overhang that we've got for the next several months, potentially, maybe the next several years, I don't know. You're talking about the level of confidence that consumers have at the moment. Where's the pricing power? And let's think through it in a way that you and the team have. Services versus goods. Where's the pricing power at the moment?
It's exactly what you said. It's in services. That's where the demand is greater. I mean, consumer goods is in deflation. And that's been one of our themes for quite a while. Now, if you add tariffs to that, then you could argue margins get pinched even more because they can't even pass it on. So that trade's worked extremely well. It's probably worked too well, quite frankly. I mean, the spread between consumer services and consumer goods, I tend to like to fade those things here, but not for fundamental reasons, just because technically it's kind of overshot. Other areas where there's maybe some pricing power could be in financials to some degree. There's still pricing power there. Anything that isn't affected by tariffs, I think, looks better at relative. Software over semiconductors is another example where semis have pricing pressure, and software is not as affected by the tariffs.
So people pegged you as a bear on the market for a number of years. People said, oh, here comes bearish Michael Wilson. I'm sure you got that all the time.
Is that what they say when Mike walks into a room?
Well, I bet that a lot of people did.
So Lisa says.
I'm a Bears fan.
Okay, hold on a second. People say that about me too. But actually what you're saying is actually quite bullish because ultimately you're saying that this ping-ponging is a trader's haven at a time where the U.S. is not on verge of collapsing and that actually lower rates could fuel another leg of equity optimism. You wrote it's premature to conclude the rotation away from the U.S. is sustainable. Do you think that we're set up for another leg higher on the expectation that maybe the Fed's going to cut into potential weakness?
The way we view it right now is that the index is not exciting. Okay, we said 6,100 almost 3 months ago. By the way, we called 6,100 when people were bearish. So, we're not always bearish, just to clarify that for folks. But 6,100 has been a really formidable level. So index is not interesting to me right here. It's kind of stuck. But there's plenty of stuff to do under the surface. I mean, that's our job. There's always something that's bullish, and there's usually something that's bearish. And that, as an investor, that's what you're trying to do. Avoid the bearish things and embrace some of the things that are more bullish.
Are there more opportunities in the U.S., though, to your point, than, say, in Europe at a time where a lot of people are saying that rotation into Europe has more legs?
Well, think of it this way. So there are more high-quality businesses in the United States, okay, period, end of story. And that's what's working. So the quality factor is continuing to to carry the day. So if you look at the concentration risk in the U.S., people go, oh my God, there's 5 stocks that are like 35%. If you go to Germany, it's like 3. You know, in Asia, it's even worse. You look at the mid-cap index in Germany, okay, it looks worse than the Russell 2000 on a relative basis. So it's just the same story everywhere. And what we've been very consistent about is in this environment where there's uncertainty, rates are probably still a little too high for the average business, the market's paying up for quality. And so in that sense, yes, there are more high-quality companies in the U.S. than there are outside of the U.S., so there's more opportunity, but then there's valuation. And so that's what we've adjusted in the last 3 or 4 months, is that the U.S. just got a little too rich relative. Now I would argue that relative valuation is probably where it should be. And so it's back to stock picking, it's back to factor selection.
You said American exceptionalism in your note has been one of the driving conversations you've had with clients. But what you're saying here right now doesn't sound like investors are falling out of love with America. They're just falling a little bit more in love with Europe.
Well, they're falling a little bit out of love with the leadership at the moment, which, I mean, in other words, they got tired. Right? We had an incredible performance into basically end of November last year. We kind of hit some targets, and then of course this deceleration in some of the numbers. I mean, one thing you mentioned, economic surprise factors have rolled over. Boy, earnings revision breadth has rolled over even harder, but it's getting to a point now where it's so extreme. So here's the 2 options I think we have. We could come into March. The numbers have been sandbagged. By the way, seasonally, that's what companies do. They sandbag the most in January because it's the beginning of the year. We wrote about that in December, like, look out for the sandbag. Okay, here it comes. But now the numbers have been reduced. So we could go into March and maybe we start to hear that maybe things aren't as bad. I suspect that the U.S. companies will sound better, relatively speaking.
Are you saying just ignore the guidance? That when people come out and they say uncertainty, ooh, numbers look bad, just ignore, fade whatever move comes on the heels of that?
I wouldn't say that. I would say that numbers are managed, okay? I mean, the companies are very good at managing numbers quarter to quarter. They're not as good as predicting the full 12 months. No different than the rest of us, right? It's easier to see 3 months than it is to see 12 months. So I think they're doing what they should be. They're being prudent about saying, we don't really know here. By the way, don't forget, rates and dollar were stronger going into the end of the year, which affected fourth quarter numbers. And, the fourth quarter had already been done. They manage those. So they had to just lower the bar just for those 2 items. Now add in tariffs, add in uncertainty around the world, and why not lower the bar? They didn't get punished that hard, for crying out loud. The stock goes down 2, 3, 4%. It's like, okay, fine, we're up 40 over last year. That's good management of your earnings guidance.
Well, how much do you think earnings are going to be affected by tariffs? You're talking about March. As Jonathan keeps pointing out, that's next week.
That's right. So we did some math on this, and it all assumes how long they stay on. So if you assume that the 25% tariffs stay on Canada, Mexico, and the 10% tariffs stay on China through this year and into 2026, we think it's about a 5 to 7% hit. So it's not insignificant. I mean, that will take us down to 5,500, probably no problem. I don't think the market believes that at the moment. I mean, we haven't seen the numbers come down, but we're talking about, I don't know, $10 to $15 hit to S&P earnings. It's not insignificant. So this is going to be a cat and mouse game throughout the year, no different than it was in 2018. Interplay with how that affects Fed policy as well. They've already mentioned that this is holding them back. So, we're dealing with it. And one last thing I just want to mention on this. I think people assume that President Trump is very focused on, he's not going to let the stock market go down. I have no idea, but he hasn't been talking that way this time. And I think this sort of idea, I know Scott Besson was on your show talking about Main Street versus Wall Street, and that is sort of, I think, how they're evaluating themselves, is how do we get Main Street to participate more in this economy kind of writ large, and shrinking the government, getting that crowding out of their hair, deregulation. Let's get rates down at the back end. They focused on that because that's what affects mortgage rates and things that American citizens care about. Okay, so I think there's a lot going on, and I am optimistic that a year from now, that I think the structure of the economy is going to be healthier if they can succeed in doing these things without damaging too much. But the path from here to there is going to be extremely messy.
Mike, just quickly, Michael Hartnett spoke to some of those issues that you've just brought up. He said the stock market is still the president's traffic light. Are you suggesting that that's not the case anymore, or just suggesting that the equity market has to fall a heck of a lot more than it has already?
I don't know, because what I can tell you is that I haven't heard him talk about the stock market, okay? Whereas I think in the first term it was all about the stock market, and now they're focused more on immigration, border, law and order, sort of basically things that can help the American citizen, maybe small businesses. There's a focus there, and then of course DOGE and what that can do to liberate the private economy. That's the storyline, and And to me, quite frankly, that's a better storyline than perhaps the first term, which was kind of about just pushing. You can't really do that this time, right? Because the crowding out has already kind of limited you on where rates are. So you can't just push on reflationary strategies now. In 2017, when we were really bullish on Trump's reflationary story, and it worked, you had a lot of slack in the economy. Today, you don't have that slack in the economy. I think they understand that.